Here's the brutal truth that will save your trading account. Only 2% of market movements represent genuine high-probability opportunities. The other 98% is noise, designed to separate you from your capital. While amateurs chase every price wiggle, professionals wait like snipers for that rare 2% edge. This isn't about finding more trades. It's about finding better trades. Most traders fail not because they can't spot patterns, but because they can't resist acting on mediocre ones. Jesse Livermore understood this after losing millions multiple times. He discovered that the market doesn't reward activity, it rewards accuracy. And accuracy comes from patience, not prediction. Think about your last 20 trades. Be honest. How many were impulse decisions driven by boredom, fear, or hope? If you're like most traders, 18 of those 20 were noise trades that bled your account. Livermore's greatest insight came through his greatest losses. After his third bankruptcy, he realized his problem wasn't identifying direction. His problem was timing and sizing. He was right about the big moves, but wrong about when to act and how much to risk. Here's the identity shift that changes everything. Amateurs trade to feel alive. Professionals trade to stay alive. The amateur needs constant action, constant validation, constant engagement. They mistake activity for progress. The professional understands that waiting is a position, often the most profitable position. Consider the mathematics. Over 100 trades, the amateur takes every setup that looks good enough. His win rate sits at 45% because he enters too early and exits too late. His average winner makes 2R, while his average loser costs 8R, 8R. Result: negative 45R, or 45% account destruction. The professional waits for only the highest probability setups. She takes 30 trades in the same period, winning 18 at 60%. Her average winner produces 8R, 8R, while her average loser costs 0R. Result: positive 38, 4R, 4R, or 38% account gain. Same market, completely different outcomes. Consider this scenario that plays out daily. Two traders watch the same stock approach major resistance at 45, 50, 45, 50. Trader A, the amateur, buys early to get a better price. The tape shows no conviction. Volume is average, and he sets a loose stop because he believes in the story. He gets chopped out when the stock fails to break through. Trader B, the professional, marks the pivotal point, defines her risk precisely, and waits. She only acts when price breaks the level with expanding volume and closes near its high. She then waits for the first higher low, buying with a defined stop just below the pivotal point. One trader gambles on hope, the other invests with evidence. This waiting isn't passive, it's active discipline. Every moment you're not in a bad trade, you're preserving capital for the good trade. Every impulse you resist based on incomplete information is money saved for the complete setup. The amateur sees waiting as missing opportunities. The professional sees waiting as creating opportunities. The market creates false signals as a survival mechanism. It must separate weak hands from strong hands. Those false signals aren't accidents, they're features designed to transfer money from the impatient to the patient. The professional demands multiple forms of evidence before committing capital. She wants price action that demonstrates genuine institutional participation. She wants volume patterns that confirm rather than contradict the price movement. She wants risk levels that allow her to be wrong multiple times without significant account damage. Before every entry, she asks the gate question: if this trade loses, will it be a clean loss according to my plan? If the answer is no, the setup isn't real. Your job is to say no quickly and yes only when price, volume, and context align. Most of your watch list is dead until the tape proves otherwise. You don't need more setups. You need sharper filters and smaller starting risk. A professional begins by defining where the trade is wrong, then calculates position size backward from that stop. If the stop is 1, 501, 50 away, and you risk 1% of a 100,000 account. Your maximum shares are 666. That math protects you from normal shakeouts and invites you to add on strength. The next 4 chapters will give you the complete protocol. How to identify pivotal points, demand confirmation from the tape, size positions for survival, and build a review system that isolates only the highest probability setups. You'll learn the single question that eliminates 80% of bad trades before you take them. You'll discover how to read volume for character, commitment, and continuity. You'll master the pyramid protocol that lets you get big only after being proven right. Doing nothing is sometimes the best trade. Waiting is a position that pays compound interest. Your edge isn't in being right more often, it's in being right bigger when you're right, and wrong smaller when you're wrong. The market rewards discipline the same way a casino rewards math. Slowly, relentlessly, and mostly when nobody is watching. Trade less, filter more, size smaller, wait longer, and let confirmation do the talking. You're entering trades where risk is unknown and exit strategy is undefined. You can't hold with confidence because you don't know where you're wrong. This is the amateur's fundamental flaw, falling in love with direction while ignoring location. Every price movement feels personal. Every pullback threatens your conviction, and every small loss becomes a battle of ego rather than capital preservation. Professionals start at the opposite end. They locate wrong first, then earn right. Before considering profit potential, they define the exact price where their thesis breaks down. This isn't pessimism, it's precision. Without a clear invalidation point, you're not trading, you're hoping with leverage. Jesse Livermore called these critical levels pivotal points, places where market control shifts from one group to another. These aren't arbitrary lines on charts. They're battle zones where supply meets demand with decisive outcomes. Think of them as the market's decision nodes, points where price either breaks through with conviction or fails and reverses. The amateur draws random support and resistance lines based on visual patterns. The professional identifies structural inflection points where probability concentrates. These levels contain market memory places where institutions and large players have repeatedly engaged, creating psychological thresholds that matter to every serious participant. Consider this scenario that separates disciplined traders from impulsive ones. A stock grinds higher for weeks, approaching its 52-week high at 45. 5, 0, 4, 5, 50. It pokes above by 15 cents on light volume, triggering breakout alerts across social media. Amateur traders pile in, convinced the move is underway. Within an hour, it's back below 45. 5, 0, 4, 5, 50 as stops cascade. That wasn't a pivotal point, it was a probe, a test for weak hands that found them. Compare this to the same stock testing 45. 5, 0, 4, 5, 50, 3 times over 2 weeks. Each test holds with slightly higher lows, building demand. On the third test, volume expands to 200% of average. The breakout bar closes at 46. 1046, 10, near its high, and the next day's pullback holds above 45. 5045, 50, on contracting volume. That's a pivotal point with character. The difference lies in preparation, volume signature, and follow-through. The protocol for identifying genuine pivotal points requires 4 specific criteria. First, identify the level through objective structural evidence. Look for prior major highs or lows where significant reversals occurred. Multi-touch trend lines respected over time. Volume-weighted average price reclaims after extended periods below. Or range, boundaries where the stock repeatedly found support or resistance. These aren't subjective interpretations, they're mathematical facts about where the market previously made decisions. The key insight is that other traders remember these levels too, creating self-fulfilling prophecies when breaks occur with conviction. Second, build your risk box by setting stops just beyond the pivotal point with a measurable buffer. Use 0.5 to 1 average true range of your entry timeframe beyond the level. If you're trading daily charts with an ATR of 2.002, 0. Place your stop 1. 0, 0, 1. 0 to 2. 0, 0, 2. 0 below a support level you're buying above. This buffer accounts for normal market noise while keeping you in during routine shakeouts. Professionals design trades around the stop. Amateurs design them around desire. Your comfort level is irrelevant. Market structure determines proper stop placement. Third, predefine position size based on distance to your stop. Risk 0.5% to 1% of total equity on the starter position, never exceeding 2% total risk including potential adds. If your account is 100,000 and you're risking 1%, that's 1,000 maximum loss. If your stop is 1,501, 50 away from entry, you can buy maximum 666 shares. 1,000 divided by 1,000 divided by 1.5 equals 666.67 shares. This mathematical approach removes emotion from sizing decisions. You're not betting based on confidence. You're betting based on the mathematical relationship between risk and reward. Fourth, demand structural integrity by ensuring the level has failed at least twice before. This creates a line in the sand that matters to other participants. A level tested and held multiple times represents genuine market memory. When such levels finally break with conviction, they often lead to significant moves because trapped traders must cover positions. Think of it like a dam. Pressure builds with each test until structural failure occurs. The more attempts a market makes to cross a threshold, the more energy accumulates for the eventual break. Your stop loss is the price of admission to the probability game. If you won't pay it, don't take the trade. This reframe eliminates emotional sting from stopped-out trades. You're not losing money, you're paying for information. The market told you your thesis was wrong at that time, and you received that information for a predetermined price. Many traders view stop losses as failures. In reality, they're insurance policies that allow you to play again tomorrow. The best breakouts often pay you to be late. Quality beats urgency every time. This counterintuitive truth separates professionals from amateurs. Yes, you might miss the first 10% of a move waiting for confirmation, but you also avoid the 80% of false breaks that reverse immediately. The cost of being late to a real move is far less than the cost of being early to a fake one. Patience allows the market to prove its intentions, separating genuine moves from traps. But a level without confirmation is just a line on a chart. Next, we'll make these levels come alive by reading what the tape actually tells us about power-changing hands, when to press your advantage, and when to stand aside with disciplined precision. Charts can lie, levels can be manipulated, but the tape reveals truth. Price and volume together tell you what institutions are actually doing with their money, not what they're saying in interviews or reports. This is where amateur analysis breaks down, and professional execution begins. You can draw perfect support and resistance lines, identify textbook patterns, and still lose money if you ignore what the tape tells you about real money flow. The market isn't a democracy of opinions, it's an auction where real capital makes decisions. Without volume confirmation, price movements become meaningless noise designed to separate you from your capital. Jesse Livermore spent hours reading ticker tape, watching how stocks behaved at critical moments. He understood that amateur traders react to what has already happened, while professionals position for what's about to happen. The difference lies in reading confirmation signals correctly. In Livermore's era, the tape literally printed every transaction, revealing the rhythm and character of each move. Today's volume analysis serves the same function, revealing the institutional fingerprints behind every significant price movement. When large players accumulate or distribute positions, they leave traces in volume patterns that trained eyes can decode. This isn't about predicting the future. It's about observing the present with unbiased eyes and reacting to factual evidence as it unfolds. Consider two identical setups that demonstrate why confirmation matters more than pattern recognition. Same stock, same pivotal point, at 32. 00, 32, 0. Same technical setup on the chart. First attempt. Price breaks to 32. 1532. 15. On average volume, the range is ordinary, and it closes at 32. 0832. 8. barely above the break level. The move lacks conviction, suggesting retail participation without institutional support. Next day, it gaps down and triggers stops as weak hands realize no follow-through is coming. This is the market's way of punishing hope-based entries. Second attempt 3 weeks later. Price clears 32. 0, 0, 32, 0 on 180% of average volume. The breakout bar is 2.5 times the recent average range. It closes at 32. 2, 8, 3, 2, 28 near the high, and the pullback 3 days later holds at 32. 0, 5, 3, 2, 5 on 60% of average volume. The tape confirmed the second break. It rejected the first. Same level. Completely different outcomes based on volume signature and price behavior. The difference between these scenarios lies in the 3C's confirmation protocol that separates real moves from false signals. Character means range expansion on the breakout. The breakout bar should be 1.5 to 2 times the 20-bar average true range. This volatility expansion signals genuine momentum shift rather than routine fluctuation. When institutions decide to move size, they create volatility. Retail traders can't generate this kind of range expansion consistently. If your breakout bar looks like every other bar on the chart, question whether anything meaningful is happening. True breakouts announce themselves through expanded ranges that reflect serious participation. Commitment requires a volume surge of 150% or more above the 20-day average on the break, followed by contracting volume on any pullback. Think of this as effort on the break, ease on the retest. Large players moving significant positions create volume spikes that can't be faked. When volume contracts on pullbacks, it suggests selling pressure is light, and the breakout has staying power. This pattern indicates that smart money accumulated positions during the break and isn't eager to sell them back at slightly lower prices. Conversely, high volume on pullbacks suggests distribution and warns of potential failure. Continuity demands that the retest holds above the pivotal point, forming a higher low, with the next impulse beginning within 3 to 5 bars rather than after extended consolidation. This timing element separates genuine momentum from false starts. Real breakouts maintain their energy and resume upward movement quickly after brief consolidations. Extended sideways action after a breakout often signals that the initial move lacked substance and institutional support is waning. The market's memory is short. If a breakout can't sustain itself within a reasonable time frame, it probably wasn't real. Context adds an optional fourth C that considers whether the broader market, sector, or related assets confirm your individual setup. Trade with the tide, not against it. A perfect setup in a hostile environment has dramatically lower probability of success. If the overall market is selling off, your individual breakout faces headwinds regardless of its technical merit. This doesn't mean avoiding all trades during market weakness, but it does mean adjusting expectations and position sizes accordingly. The execution rules eliminate ambiguity about when to act and when to step aside. Enter on the first higher low after successful break and retest, not during the initial breakout excitement. This patience allows the market to prove its intentions while giving you better risk-reward setup. If any of the 3 C's fail during your observation period, abort the trade immediately. Don't rationalize or hope for improvement. The tape is telling you the setup isn't working. Never enter on hope, only on evidence. This disciplined approach removes guesswork, transforming trading from speculative gambling into calculated probability exercise. If the tape doesn't confirm, it didn't happen. Price lies. Price and volume together tell the truth. This maxim reframes how you evaluate opportunities. A stock can reach new highs, but if volume is declining and ranges are contracting, the move lacks substance. Conversely, a stock making modest new highs on expanding volume and ranges deserves attention. The combination creates a three-dimensional view of market behavior that single indicators can't provide. Waiting for confirmation feels like you're missing the move. You're not missing it, you're ensuring it's real. This psychological shift separates patient professionals from anxious amateurs. Yes, you'll enter after some initial move has occurred, but you'll also avoid the majority of false breakouts that reverse immediately. The cost of being late to a real move is far less than the cost of being early to a fake one. Confirmation acts as your quality filter, ensuring you only engage when probability genuinely favors your position. Now you have both a level and live confirmation from the tape. But how much should you bet? And when do you add more? Position sizing separates survivors from casualties in this probability game. Perfect trade selection becomes worthless with improper position sizing. You can be right about direction and still lose money if you size incorrectly. This is the cruel mathematics that destroys more accounts than bad analysis ever could. Most traders fail not because they can't find good setups, but because they bet too much too early. They confuse conviction with position size, treating confidence as justification for larger risk. The market doesn't reward your certainty, it punishes your overconfidence. A string of 3 losses at 1% each creates manageable drawdown. 3 losses at 5% each creates a hole that demands perfect execution just to break even. Jesse Livermore learned this lesson through spectacular bankruptcies that cost him millions and taught him everything about survival. Being right about Union Pacific's direction didn't matter when he risked his entire account on the position. He could predict major moves with uncanny accuracy. Yet his inability to manage capital through inevitable fluctuations nearly destroyed him multiple times. After his third bankruptcy, he developed the systematic approach that separated emotion from execution. Start small. Add to strength, never to weakness. This wasn't about lacking confidence, it was about respecting uncertainty. Even perfect setups fail sometimes, and longevity requires acknowledging this mathematical reality in every sizing decision. Consider 2 traders who identify the same confirmed breakout at 28, 502, 8, 50. Both see identical opportunity, both understand the setup, both expect the same outcome. Trader A risks 5% of his 100,000 account, putting 5,000 on the starter position by buying 1,000 shares with a 23, 5023, 50 stop. When the stock pulls back to 27, 0027, 0 still above the pivotal point and within normal retest behavior, he watches his 1,000, 500 open loss and panics. The pullback feels catastrophic because his position overwhelms his psychology. He sells to stop the pain, missing the subsequent rally to 35, 0, 0, 3, 5, 0. Trader B risks 1% of her 100,000 account, limiting exposure to 1,000 on 200 shares with the same 23, 5023, 50 stop. During the pullback, her 300300 open loss feels manageable. She recognizes healthy retest behavior and adds another 0.5% risk, buying 100 shares at 27, 2527, 25, at 31, 00310. After the stock proves its strength, she adds final 0.5% risk with 83 shares for total 2% exposure. Her average cost becomes 27, 89, 27, 89, and she rides the move to 35, 0, 0, 3, 5, 0 for 2,000 profit. Same setup, radically different outcomes based purely on position sizing psychology. The 1-1-1 pyramid protocol eliminates guesswork by creating systematic rules for when and how much to add. Start with 0.5% to 1% of total equity at first confirmation. For a 100,000 account willing to risk 1,000 with 5, 005, 0 stop distance, buy 200 shares maximum. 1,000 divided by 1,000 divided by 5 equals 200 shares. This starter allows participation without emotional interference. If wrong, the loss is manageable. If right, you have room to build, as the position proves itself through market validation. First add comes only after achieving +1 open profit and observing higher low above the pivotal point. Add another 0.5% risk while moving the entire position stop to break even. This rule ensures you only increase exposure after market validates your thesis. The higher low requirement confirms the stock builds on strength rather than bouncing randomly. Moving to break even removes initial risk, transforming the trade into house money that reduces psychological pressure dramatically. Second ad requires +2R open profit and another higher low formation. Add final 0.5% risk while trailing stops under rising swing lows. Maximum total risk never exceeds 2% on any single idea, including all additions. By this point, the stock demonstrates sustained strength through multiple confirmations. Your average cost sits below current price, and stop management protects accumulated gains while allowing continued participation in extended moves. Position management rules eliminate discretionary decisions that lead to mistakes. Never add to losing positions. This violates the entire protocol and transforms systematic trading into gambling. The market tells you you're wrong. Listen immediately. Take 25% to 33% profits at +2R to bank emotional capital, reducing position stress and making it easier to hold remaining shares for larger moves. Trail remaining position with rising stops or anchored volume-weighted average price. If tape loses any 3C's confirmation criteria, exit immediately to flat, regardless of profit or loss. Mathematical precision removes emotion from sizing decisions. For 100,000, 100,000, account with 1,000, 1,000 maximum risk per starter, stock at 30. 0, 0, 3, 0, 0, with stop at 28. 5, 0, 2, 8. 50 creates 1, 5, 0, 1, 50 risk per share. Maximum position size, 1,000 divided by 1,000 divided by 1.5 equals 666 shares. This calculation ignores confidence levels, recent performance, or market opinions. It only considers mathematical relationship between account size, acceptable risk, and stop distance. Emotion has no place in this equation. You earn the right to get big by first being right. Size follows success, never precedes it. This maxim reframes position building from prediction to reaction. You don't start large because you're confident. You grow large because you're proven correct. The market rewards this patience by allowing you to compound winning positions while limiting damage from losing ones. Most traders reverse this. They start large based on conviction and refuse to add when proven right, because they're already fully invested. Doing nothing between adds is active discipline. Patience compounds profits. The space between additions isn't dead time, it's evaluation time. You're monitoring higher lows, watching volume patterns, ensuring 3Cs remain intact. This weighting separates systematic traders from impulsive ones. Each addition must be earned through market behavior, not granted through hope. You now have the complete technical framework. Pivotal points for location, 3Cs for confirmation, pyramiding for position management. But how do you ensure you only apply these tools to genuine A-plus setups? The final chapter reveals the review system that isolates the true 2% edge from market noise. You can't improve what you don't measure. Amateurs remember their wins and forget their losses, creating false confidence that leads to repeated mistakes. They celebrate the 3 trades that worked while conveniently ignoring the 7 that didn't. Professionals record everything and let data reveal their true edge. Your 2% advantage doesn't live in your analysis, it lives in your review system. Without systematic measurement, you're flying blind, making the same errors repeatedly while convincing yourself you're improving. The market has infinite ways to separate you from your capital, but only a few ways to consistently deliver profits. Jesse Livermore kept meticulous records, not just of profits and losses, but of market conditions, his reasoning, and his emotional state. He understood that trading is a probability game played over hundreds of trades, not individual outcomes. Each trade was a data point in a larger experiment designed to isolate what actually worked from what felt good. His journals revealed patterns invisible to casual observation. Certain setups worked better during specific market conditions. His emotional state affected execution quality, and his best trades shared characteristics he hadn't consciously recognized. This systematic approach transformed him from an impulsive gambler into a calculated speculator who could replicate success. Consider this real example that demonstrates the power of systematic review. A trader journals 50 trades over 3 months, tagging each setup type and recording detailed metrics including entry reason, market context, emotional state, and outcome. The data reveals shocking truth. 3. Specific patterns generate 85% of his profits. Weekly breakouts with 3 C's confirmation. First pullbacks to anchored volume weighted average price after breakouts, and failed breakdowns at major support with heavy reversal volume. Everything else is noise, generating random results that waste time and capital. He eliminates the noise patterns and focuses exclusively on his 3 proven edges. His win rate drops from 65% to 55%, but his average winner increases from 1.8R to 3.2R. His equity curve smooths dramatically as he stops taking marginal setups that create emotional turbulence without generating consistent profits. Same market, completely different outcomes based purely on systematic elimination of what doesn't work. The 2% review protocol creates systematic filters that separate genuine opportunities from market noise. First, A divided by B grade every setup before considering entry. A setups meet all criteria: clear pivotal point, 3 C's confirmation, proper market context, and defined risk box. B setups miss something critical, either pass completely or size minimally for data collection purposes. This binary system eliminates the gray area where most losses occur. You're either trading your best setups, or you're not trading at all. Second, score each potential trade on a 0 to 5 scale, based on completeness of criteria. Only execute trades scoring 4 or 5, tracking correlation between scores and outcomes over time. This numerical system removes emotional bias from trade selection. A score of 3 might feel tradable in the moment, but data will show these marginal setups produce random results. Discipline means passing on anything below your proven threshold, regardless of how much you want to trade. Third, track key metrics by setup type to identify your true edges. Monitor win rate, average R multiple, maximum drawdown, average holding time, and time of day effectiveness for each pattern you trade. Calculate expectancy using the formula: average win times win rate, average loss times loss rate. Track this in R multiples, not dollars, to normalize across different position sizes. Build a simple heat map showing which setups work in which market conditions. If weekly breakouts in uptrends show +0, 85 R expectancy, while everything else shows +0, 5 R or negative, your path becomes obvious. Fourth, implement monthly elimination by cutting the bottom 25% of setup types based on risk-adjusted returns. This ruthless culling forces you to focus on what actually works, rather than what you think should work. Many traders hold on to losing strategies because they understand them intellectually, even when data proves they don't generate profits. Professional trading requires abandoning personal preferences in favor of mathematical evidence. The pre-trade gate question eliminates most bad trades before they occur. If this trade loses, will it be a clean 1R loss according to my plan? If you can't answer yes immediately, the setup isn't real. This question forces you to define risk precisely before entering, ensuring every trade has predetermined exit criteria. Most losing trades fail this test because traders enter based on hope rather than defined probability. The one question that kills bad trades asks, am I trading my plan, or am I planning my trade? If you're making up rules in real time, adjusting criteria to justify a position, or modifying your system mid-trade, you're gambling, not investing with an edge. Your plan should be complete before market open. Execution becomes mechanical application of predetermined rules, not creative interpretation of evolving situations. Professionals codify decisions when calm and execute them when uncertain. This separation protects you when the tape turns slippery and your mind starts bargaining with the market. Implementation follows a systematic 4-phase schedule. Weeks 1 and 2 focus on journaling all setups with screenshots and detailed reasoning, building the habit of documentation. Weeks 3 and 4 introduce A divided by B grading and 0 to 5 scoring systems, creating objective evaluation criteria. Month 2 analyzes accumulated data to identify patterns and eliminate worst-performing setups. Month 3 and beyond, focus exclusively on proven A-grade setups while refining execution quality. Your edge isn't in your analysis, it's in your discipline to only trade when analysis meets all criteria. You don't need more setups. You need fewer setups executed with boring consistency. The 2% edge isn't about finding magic patterns. It's about building systematic filters that identify when probability genuinely favors your position. Define pivotal points. Demand 3C's confirmation. Size for survival, not excitement. Review ruthlessly. Trade only your highest probability setups. Cut losses fast at predetermined levels. Size small to survive inevitable losing streaks. Wait for complete confirmation before acting. Own your process, not just your profits. If this systematic approach resonates with you, our next lesson on timeframe alignment and multi-touch confirmation will show you how to stack probabilities across different time horizons for even higher quality setups.